Hey everyone, welcome back to the channel. Today I'm going to walk you step by step through exactly how you can start a dividend stock portfolio with just $1,000 in 2025. I'm going to break it down so that even if you've never bought a stock before, you will know what exactly to do, what to look for, and how to avoid common mistakes. We'll go over the pros and cons of dividend investing, key components to look for in dividend paying companies, and I will give you a sample $1,000 portfolio you can copy or use for inspiration. We'll also analyze each stock in the portfolio so you know exactly why it's there. Before we start throwing money into the market, let's make sure we understand what dividend investing actually is. Dividend investing is when you buy shares of companies that pay you a portion of their profits in cash on a regular basis, usually quarterly, but sometimes monthly. Think of it like owning a small piece of a business, and every few months the business cuts you a check for being a shareholder. That's passive income, and the best part is that those dividends can be reinvested to buy more shares, which leads to compounding over time. This is how small amounts of money can grow into something much bigger. Now, before we get too excited, let's talk about the pros of dividend investing. First, it gives you a steady stream of passive income. Even if the stock price doesn't move much, you're still getting paid just for holding the shares. Second, dividends can be reinvested automatically, meaning you can buy more shares without having to add extra money to yourself. Third, dividend paying companies tend to be more stable, established businesses. Think of utilities, consumer goods, and big banks, so they can be less volatile compared to growth stocks. And finally, dividends can help you hedge against inflation. If your dividends grow over time, they can keep up with rising prices. But it's not all sunshine and rainbows. There are cons to dividend investing too. For one, not all companies can maintain their dividends. Sometimes they cut or suspend it when times get tough, and that could hurt your income and your stock price at the same time. Second, focusing too much on dividends can lead you to ignore the actual health of the company. A high dividend yield might look attractive, but if the company's profits are falling, that yield might be unsustainable. And third, dividend investing often means you're in slower growing companies. So while you might get cash flow, you may miss out on some of the big explosive gains that growth stocks can offer. Finally, there are tax considerations depending on where you live. Dividends might be taxed every year even if you reinvest them. So if we are starting a portfolio with $1,000, how do we pick the right stock? First, you want to look at the company's dividend yield. That's the annual dividend payments divided by the share price. A healthy range is usually between 2% and 5%. Anything above 7 to 8% can be a red flag that the company is in trouble. Second, check the payouts ratio. This tells you what percentage of profits are being paid out as dividends. If it's over 80%, it could mean the company is stretching too far to pay investors and might cut the dividend. Third, look at the company's dividend growth history. A company that has increased its dividends every year for the last 10-20 years is usually a sign of a strong financial health. Fourth, you want solid fundamentals, steady revenue growth, manageable debt, and a strong competitive position in its industry. Now let's talk about the sample $1,000 dividend portfolio for 2025. We are going to keep it diversified, use low-cost ETFs, and also include some strong individual companies. Here's the breakdown. SCHD, which is Schwab US Dividend Equity ETF, is $400. J&J, which is Johnson & Johnson, $200. PG, which is Procter & Gamble, $150. O, which is Realty Income, $150. And MSFT, which is Microsoft, $100. Now let's go through why each one is here. Starting with SCHD, this is one of the most popular dividend ETFs in the world. It holds around 100 high-quality US companies with strong dividend history. The yield is around 3.5% right now, but more importantly, these companies inside SCHD have a track record of increasing their dividends over time. It's diversified across industries, so you're not putting all your eggs in one basket. And the expense ratio is extremely low at 0.06%, which means almost all your returns stay in your pocket. Next, Johnson & Johnson. J&J has been paying dividends for over 60 years without missing a beat, and they've been increasing their dividends every single year. That's called a dividend king. The company's in healthcare, which is an industry that tends to be stable even during recessions because people still need medicine and treatment. Their payout ratio is reasonable, their balance sheet is strong, and they have a global presence. Procter & Gamble is another dividend king, paying and raising dividends for over 65 years. They own household brands like Tide, Gillette, Pampers, and Crest, products people buy no matter what the economy is doing. The yield is around 2.5%, but the stability and consistency are what make PG a long-term winner. Then we have Realty Income, also known as the monthly dividend company. O pays dividends every single month, which is great if you want more frequent cash flow. They invest in commercial properties. Think of Walgreens, Dollar General, FedEx, and other reliable tenants. The yield is usually around 4% to 5%, and they have a long history of stable payouts. Finally, Microsoft. You might be wondering why I included it since the dividend yield is only 0.8%. But Microsoft is a growth and dividend stock combined. They have huge cash reserves, dominate the tech space with products like Windows, Office, Azure, and now AI, and they've been growing their dividend consistently. Adding a company like Microsoft gives your portfolio a little more growth potential over time while still collecting a small dividend. If you invested $1,000 into this portfolio today, you'd be getting an average yield of around 3 to 3.5%, which is about $30 to $35 a year in dividends to start with. That might not sound like much, but here's where the magic happens. If you reinvest those dividends plus add more money over time, you'll start seeing compounding kick in. After a few years, that $30 becomes $100, then $500, then $1,000 a year in dividends. And that's without selling any shares. The key is growing your dividend portfolio is consistency. Keep adding to it every month, even if it's just $50 or $100. Don't chase the high yield you can find. Instead, focus on quality companies with strong balance sheets and a history of increasing dividends. Use DRIP, which stands for Dividend Reinvestment Plan. so your payouts automatically buy more shares for you. And finally, have patience. Dividend investing is a long-term strategy. It's not about doubling your money overnight. It's about building a steady, reliable income stream that could eventually cover your expenses. So to wrap this up, starting a dividend stock portfolio with $1,000 is absolutely possible in 2025, and you don't need to overcomplicate it. Stick to quality companies, diversify, reinvest your dividends, and keep adding money consistently. Over time, you will see the power of compounding work in your favor, and that's how you turn a small amount into something life-changing. With that being said, if this video helped you out, make sure to like the video and subscribe for more content like this. I will see you in the next one.